Are you a broke loser? Do you want to stop being a broke loser? Well, buy my book on Amazon. It's $2.99 for an ebook or $9.99 for a hardback. It's called Stop Being a Broke Loser. If you buy this book, you will no longer be a broke loser. So buy it now. Welcome back to my channel. I am Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser. It's for $3 on Amazon. I know. Rip-off! And current reviewer of Corsair stock. Is it a buy? Is it a hold? Is it a sell? Well, guess what, ladies and gentlemen? In my personal opinion, for me, based on my required rate of return, and taking into consideration that I keep 95% of my portfolio in total world index funds, and I leave 5% for speculation, I don't think Corsair is a bad speculative bet. Okay? Let's go look at the Everything Money software, which I just bought. $26 a month. I just bought it. I'm poor now. We're going to use our software, and we're going to put in some assumptions, and we're going to see how much Corsair is really worth. Let's go. Man, I love using somebody else's software. You know how much work it takes to put in a bunch of formulas in an Excel sheet, and then it's ugly and disgusting. This is actually a pretty good deal, this Everything Money software, at least for now. They actually raised the rates to $100 a month, $150. May want to reconsider, but for now, $26 a month, in my opinion, if you want to screw around with individual stocks, which I really don't recommend, except for more than 5% or less than 5% of your portfolio, this is probably the best deal out there. Now, this is Corsair Gaming. You know, it's Jeremy Lafufu's company. You know, he's been pumping it, and it's one of the few stocks that I was not really against. I actually looked at this company a couple months ago. My main concern with Corsair Gaming was last year they had a pretty significant increase in revenue for the year ending 2020. And my concern was, well, we had the pandemic, the thing that happened, and a bunch of people got stimmy checks. Everybody was stuck at home. Everybody wanted to become a streamer. And I was like, well, you know, maybe the reason the revenue went up so much is because everybody had all this money and they were just pouring money into gaming and streaming software. Well, we're going to look at the income statement. And I mean, we're still kind of getting through the pandemic, and people are still getting, you know, stimulus checks or unemployment benefits, and there's still money slushing around the economy. But if the trend continues of revenue growth, even after a lot of the stimmy wears off, I think the company's growth, you can more reasonably assume the company's revenue growth. But in my stock analysis, which we're going to look at the end using the stock analyzer tool, I was extremely conservative. And even then, the numbers came out pretty decently. So let's go ahead and look at the income statement. And what I like about this is you can look at it annually and quarterly. So this is the operating revenue for annual. And you can look at quarter to quarter. Now, what confused me is we have, from left to right, we have the quarter ending June 2021, the quarter ending March 2021, the quarter ending December. So that's 333, okay? And then it's 12, 9, 6. Okay, that's 333. And then they jump back 6 months here. So it's quarter to quarter, quarter to quarter, quarter to quarter, quarter to quarter, and then it's 2 quarters smashed together. So I don't know what happened to, maybe I'll report a bug for this, but I don't know what happened to the quarter ending March 3rd, 2020. That's a glitch. Everything Money. Disgusted. You're fired. So, anyway, looking at this, if you compare the quarterly revenue from for the quarter ending June 2021, $472 million. Compare that to the depths of the pandemic, $380 million. So there's decent growth there. And if you want to calculate the revenue growth quarter over quarter, 24% revenue growth. And as you'll see on the stock analyzer tool, I was way more conservative than that. All right, so the next thing you want to look at, Everything Money loves to look at the current ratio. I mean, it's fine to look at. It takes 2 seconds, but I'm not worried about this company going out of business, okay? The main thing I care about, and when I agree with what they look at, is the share dilution. So here in shareholders' equity, you can look at total capital stock, and it's kind of hard to tell, but I guess you can kind of see dilution there. Because if the total capital stock account goes up, they're issuing more shares. So it went from 8 to 9,000. So it looks like there was some share issuances there. All right, cash flow. I mean, you can look at cash flow from operations. It's up almost 50% for year over year, which is pretty good. Even after the pandemic is starting to wane, hopefully. So that's not bad. So it's okay. Debt repayment. Cool. 8 pillars. Didn't load. Maybe I didn't click a button right. I don't know. If I screwed something up, don't sue me, okay? But now let's get to the stock analyzer tool. So from my understanding for how this works, and you need to go freaking do this yourself, okay? This is not, I'm not telling you to buy this stock. So if you go buy this stock and then it crashes to 0, don't freaking sue me, okay? And I don't even know if I'm going to buy this stock. I mean, I like it, but I don't know. I'm kind of... Part of me wants to wait until the end of the year so I can max my IRA. But who knows? Maybe I'll decide to buy this stock in the next couple of days. So from my understanding, when you're looking from left to right, it's worst case scenario to best case scenario. That's how Paul explained it in this little stock analyzer tool video. And it's actually nice that this video is only like 3 minutes, because if it was 10 minutes, I wouldn't have watched it. Now, here's what I did. So I was very conservative. With revenue growth, I went 1%, 3%, and 5%, which is insanely lower than the 40% revenue growth year over year. Like I said, my main consideration there was I really wanted to test this stock to see, you know, how undervalued it could potentially be. But another main reason I did this was, what if the pandemic ends and then all the stimulus is gone? Are people still going to be buying this decently expensive computer software? I don't know. I was super conservative, so I said, worst case, 1% revenue growth over the next 5 years, 3 or 5%, best case. Share change. Now, it's still a growing company, so there might be some dilution. So I said, worst case, 10% share issuances, which is pretty extreme every freaking year. 5%, 1%. Profit margin, they had a 7.6 profit margin, so I was still pretty conservative. They may actually increase their margins as they become more profitable, or as they grow more. I said, worst case 5, best case 10. Free cash flow is a percentage of revenue, 6, 6.8, and 8. Price to earnings ratio, 10, 12, and 15. Now, the reason that a higher PE ratio is best case is because if you sell the stock after 5 years, the price to earnings multiple, the higher it is, the more you can sell the stock for. That determines the stock price. Price to free cash flow, I put the same numbers. And here's the thing that some people might disagree with, but I'm going to just show you why I'm correct. My desired annual return, best case, is 20%. Then it's 17.5%, and then it's worst case 15%. If I'm going to buy an individual stock and take any freaking risk, as opposed to buying an index fund, which historically has returned 10% annualized, I might as well be assured that I'm going to get a massive banger return. I'm talking 15 to 20%. If I can't get 15 to 20%, I'm not touching the freaking stock, okay? That's just how I feel. Jay Nagy also pushes that. Makes total freaking sense. I mean, he's kind of the one that came up with the original idea. And a lot of the times, Everything Money, they use, they'll use 10, 12, and 15. I think that's too, I don't think that's enough to take the risk of buying one company, because you never know what can happen to a company. I mean, this company could collapse and you could lose all of your money. Whereas the total world stock market index fund, sure, it could go down. 100% it can go down. But you'd have to really like have almost every company in the world go extinct to really lose your money in the long run. So anyway, that's my opinion on that. If you don't like it, call a lawyer. All right, so let's analyze and let's see. So, low assumption. This basically says if you want to get a 20% return, you need to buy the stock at $5.41. So obviously the stock is way above that. It's at 28 cents. So you're not going to get a 28. You're not going to get a You're not going to be able to buy the stock at that price, probably. But remember, I was insanely conservative with my revenue growth. You know, what if the stimming runs out, blah, 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 blah. But even then, with all these pretty conservative assumptions, look at the worst case scenario. 5% revenue growth, share dilution, profit margin, all this 10%, 8%. You still have a buy at roughly the stock price. So it's hovering right around the 15% buy point. Now, what if we increase the revenue assumptions? What if we did 10, 15, 20? Look at that. I mean, you're probably going to get a 15% return, assuming this is accurate. Because look at the high point. Look at the high assumptions. If you wanted to get a 15% return based on a multiple of earnings, buy it at $50.62. It's well below that. Or $40.50 for discounted cash flow. Look, I want to reiterate, I'm not even sure if I'm going to buy this stock. I'm kind of tapped out of buying freaking stocks, okay? I like buying index funds. I probably have maybe 3% of my net worth in individual stocks. It is mostly Alibaba. And I just don't like individual stocks. I think they're too risky, and I think the average person is much better off just not screwing around with individual stocks. But if I were to consider buying this stock, I mean, right now I feel pretty decent about it, to be honest. I don't feel horrible about it. If I was to invest in this stock, I'd maybe put like, and this is just based on my net worth, maybe $1,000 into it. Whatever, see what happens. Speculative investment, but you know, the trends seem pretty good in my humble opinion. But that's it. If you want to buy this stock, I would say buy the freaking software for a month and just practice. Just put numbers in here, use some reasonable assumptions, and get a good feel for it. And if you feel comfortable, because everybody wants a different return. I mean, what if I wanted a 5% return or a 10% return or a 12% return? Well, I mean, really changes the numbers, doesn't it? So you do your own freaking research. And if you're not sure, if you're not comfortable, just max your tax advantage accounts. And to be honest, you really shouldn't be doing any of this unless you've been maxing your tax advantage accounts, which I have. Anyway, that's it. Like, subscribe, tell your friends about me. Y'all have a wonderful, delicious, superstitious, cockalicious day.